So guys, it's time to wake up. There is a massively brutal impact of these sort of seemingly unending rate hikes by the Fed. And sure, they do have their reasons for them, of course. And sure, inflation has cooled a bit, but at what cost? In today's episode, we're going to explore that cost in depth. You're not going to want to miss this one. All right, guys, I want to welcome you back to the VIP Financial Education YouTube channel. My name is Matthew Pillmore, and I'm here to help you go further, faster, financially. Now, I get it. The title of this video might seem like we've sort of blown this interest rate situation out of proportion. But I assure you, there are some incredibly unsettling prospects to how the Fed has handled those inflation situations and the issues that we've been experiencing over yesteryear. And I believe it goes without saying that the Federal Reserve's decision to sustain high interest rates is now significantly impacting U.S. consumers. While the American economy has managed to remain resilient since the Fed began its aggressive rate hikes last year, the long-term implications are now evident. Many American households were shielded initially, thanks to their previously secured low-interest loans for mortgages or vehicles. And one silver lining, of course, is that these high rates benefit savers like myself that are receiving better returns on my money that's sitting idly in a savings account right now. However, the continuous high interest rates are now burdening many households that are currently borrowing money, particularly for larger purchases like homes and cars. And the increase in credit card interest rates, which moves in tandem with market rates, is pushing many near the edge of the cliff. And we all know that the Federal Reserve's intention behind these hikes is to decelerate the economy in order to control inflation, and that's the Fed's recent indication of another potential rate hike later this year. It's suggesting that relief is really not on the horizon yet. So I want to dive deeper here. For the first time in a while, inflation has become less of a concern. So during the summer, wages were actually outpacing inflation, marking the first such instance since back in 2021. Despite the rising costs of everything, consumers are still out there spending on all of this non-essential junk. And we're stacking up record amounts of credit card debts right now. And although the surplus funds that were saved during the pandemic's onset, they've been used up at this point, and household balances remain higher now compared to 2019. While the job market remains robust right now, certain industries are actually very sensitive to the rate hikes. That includes people like mortgage lenders, for example. They're now downsizing. I even saw mortgage lenders clawing back hiring bonuses. And the majority of Americans right now are really feeling the brunt of these Fed policies, these elevated interest rates, and they can cause significantly increased monthly mortgage payments right now, especially given property prices that have been surging since the pandemic. And data from the Atlanta Fed suggests that as of July, the average US household spent 44% of its income on yearly payments for a median priced house. This is the highest proportion on record since 2006. And we all knew what happened after that, right? Car buyers are also grappling with the multiplying challenges of inflated vehicle prices and higher interest rates. Car dealerships are in big trouble. Based on experience data, the monthly repayment for a new car right now hovers at around $725, while used cars are averaging over $500 every month. With debt on the rise, Americans are accumulating historic credit card and auto loan balances, and increased interest rates are going to further strain their financial capabilities. There's an alarming trend that's on the rise in overdue credit card and auto loan balances that are now surpassing pre-pandemic levels. You add that to the reinstatement of federal student loans after the 3-year hiatus into the mix, and we have a pressure cooker situation right now for many American households. Furthermore, as if it couldn't get any worse, people are resorting to short-term high-interest loans again. There's a recent study by LexisNexis Risk Solutions that highlighted a 35% year-over-year surge in first-time users of such loans in just the second quarter of 2023. And the last thing I want to point out is obtaining those types of loans is becoming increasingly challenging. Even regular loans. There has been recent data from the New York Fed revealing that nearly 60% of households felt it was now more difficult to access credit compared to the previous year. Maybe you felt this. Let us know in the comments. And this is the highest since 2013, folks. So ultimately, the rates that have been set by the Federal Reserve, they have had this domino effect on the US economy, and it's impacting various sectors very differently. While there are some households initially that benefited from low interest rates on prior loans, the persistent high rates are now proving detrimental, particularly for those that are looking to make major purchases or use credit in any capacity. So this multifaceted financial strain of sorts, if you want to call it that, this underscores the profound implications of prolonged high interest rates on the American household economy. And we've detailed some of the issues that the economy faces in other videos, so I don't want to go too deeply into that here. I'll put some of those links in the description for you, but I do want to say that the chips continue to stack less and less in our favor. And that means that we have to make smarter bets with the chips that we do have. Now, if you've been following the channel, you're going to know that we've talked about passive fix and flips here over the past handful of months. And we've featured this for several months on the channel and how we've been seeing an average of 50% year over year cash on cash returns on those deals. And to those that haven't seen the videos, I'm going to make sure I leave links to those in the description as well. But that said, I bring the passive fix and flip model up as just an example to show you that there really still are ways that you can make the most out of this seemingly negative situation. These higher interest rates, they're going to negatively affect people that are looking for a mortgage far more so than those that can, say, pay cash for a house. So higher end fix and flips in the right markets, they have a much higher yield potential than those sort of traditional lower end fix and flips might, because they're going to be too difficult for most people to get into, especially when debt is so expensive because of the high interest rates. So this means that the average real estate investor is just simply going to be priced out of these types of deals. And that's one of the reasons that we've featured the Maven passive fix and flip recipe on this channel. They enable folks to get in for as little as $50,000. That money can come from anywhere. You pair that with the fact that the ROI on these deals is set at a specific percentage from the beginning of the project, so you know exactly what to expect in as little as 6 months' time on average, and you've got sort of this diamond in the rough as an outcome as far as I'm concerned. Now, I don't bring Maven up to push you towards it necessarily. Rather, I really just want to show you that there still are ways to navigate these times as an investor, ways that can produce really impressive results. In my coaching sessions that I've done now for 15 plus years, I have a lot of conversations around what one should do as an investor right now, and the landscape is really so different than it's ever been and how it used to be. So we can't rest on the laurels that we once did. For some, the high interest rates are going to be destructive. Those who rely too heavily on debt for the wrong reasons, they're going to be set back even further in years to come. Then there are those that will be frozen in place for years because of sort of that paralysis of analysis. And they're gonna sit on the sidelines and they're gonna wait and they're gonna wait and they're gonna wait for the rates to come back down. And then there are those that will accept the reality of the rates, whatever they may be, and they're still going to be looking for ways to invest, to grow in order to build wealth over the long term. Folks, no matter what the economic circumstances might be, there are those who continue to win. It's all about finding out exactly how they're doing it and then just replicate that for yourself. We're going to continue to show you the ways that we've used ourselves that are working and the ways that we've witnessed others are using to win as well. And at the end of the day, the choice is going to end up being yours, whether you let these high interest rates keep you on the sidelines for years to come. I hope that that's not the case for you. I hope you continue to take action. I certainly do every single day. I'm taking action. If you enjoyed this video, it would certainly help us out a lot if you drop a thumbs up on it. If you decide you didn't like the video, please drop it a thumbs down. Let us know what you think. Either way, we're here again to help you make the most of whatever economic circumstances we're all up against at this time, to beat the banks at games that are intended to trap you, to keep you down in order to make the banks as much money as possible. Many banks are struggling right now too. So they're going to continue to pile on those fees, try and institute things that are complicated and confusing and ambiguous in order to make you confused so that you don't understand how to make the most out of your spending. Recently released a video about how credit card debt is one of the biggest traps out there. If you continue to use a credit card that you revolve a balance on month after month, you are falling into one of those ambiguous traps. Make sure you check the description for a link to that video as well, or I'll put it on the screen here now. Either way, I hope you subscribe to the channel. We are here to bring you some of the best resources in order to help you leapfrog your way to the financial independence and financial lifestyle that you and your legacy are looking to achieve. So until I see you on the next one, I hope you make it a great day today and keep on cash flowing. Take care.